Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video, I want to look at two companies in the financial sector. Okay, I've talked about this in so many times in terms of trying to diversify my portfolio. As you can see, 28% of my portfolio is in the information technology, healthcare is 21%, industrials 20%. This is, by the way, the dividends basically companies only. It doesn't include Salesforce and Adobe's and so on. Okay, and as you can see here, I don't have any utilities, energies, communications, real estate, and financials. So today we're going to look at couple of companies that I could potentially add to my portfolio from the financial sector, okay, that are Sharia compliant. And the two companies that I'm interested are, okay, SPGI or S&P Global, and the next one is Moody's. Those two companies are down quite a bit at the moment. So today, as the market is open right now, one is down 1.61% and the other one is down almost 3%. Okay, SPGI or S&P and Global and S&P and Global is actually down year to date 24.44% since the beginning of the year. That's quite a lot. Okay, but these are the companies that have been doing really well in 2020 and 2021, so I'm not surprised. So what we want to do is we talked about this company before and we talked about Moody's before. So what we want to see today is, are they actually a buy right now? Okay, so that's the question that we need to answer. Again, this one is almost down 2%, but for the year to date, it's almost down 21%. So one is down 24%, over 24%, and the other one is down 21%. So are they a buy right now? Let's check it out. Right, so the first one we're looking at is S&P Global. This company is basically a credit rating company agency basically, and they're the best in the world, they're the biggest in the world. They deal with a lot of market intelligence indices. They deal with a lot of banks and so on. So they work with the banks. They actually rate their investments and all of that stuff. Okay, and these are things that are not require a lot of overheads. And what I mean by that is they don't have to create actual products. They do have software that allows them to actually do these analyses, and they have people on the ground that actually collect all that data and analyze that data and then report back to these companies. So when basically a new bank wants to invest in something, they actually go to these companies and they give the ratings. Even they rate the S&P 500 companies based on the debt levels and so on. So those, there's not a lot of overheads if you think about it. They don't actually create actual products. So profitability, they should be really good. So right now, this company is trading $348 per share, EPS of over 13, almost to $14, okay, per share. Market cap of $124.7 billion. Economic mode is wide. So again, both companies will have economic mode wide because there's not much of a competition. But basically, they monopolize that market between the two of them. Capital allocation. So the company, the management are doing really well in allocating that money wisely. Beta is quite low, lower than 1, which is quite nice. P ratio 25, slightly higher. In fact, let me find out what the sector is. I'm sure the sector, I'm not going to bother because sector is normally about 12. And when we look at the financials, it's full of banks and so on. So the banks normally tend to have a lower PE. So I'm not even going to bother with that. Price to free cash flow here, 24, almost to 25. Enterprise value to EBITDA, 28. So more or less kind of same similar range. Dividend yield, slightly low, okay, just below 1. 5-year growth rate of 16%. Dividend growth streak of 48 years. Payout ratio 22%. Dividend safety of 99%. Free cash flow here, $3.5630 billion in the bank, which is quite nice. So that means they can cover that dividend, no problem. Okay. Profit margin 36.5. This is what I expect from this company because there's not a lot of overheads. Operating margins, okay, 54.6%, really good. Return on equity 73%. We're looking about 15% or 12% and so on, but that is absolutely amazing. Return on total returns percentage on the last 10 years, okay, 22.91%. That's more or less what the big boys are doing, the Microsoft is and all of that. Current ratio above 2.31. So when it comes to debt levels, you don't have to worry about that. In terms of growth estimate in the next 5 years, according to Yahoo Finance, is 14.2. This is what you expect again from a growth company, not this type of company that's been around for a long time. Now, I'll come back to this too because it's a weird situation going on. So I'll tell you what that is in a second. But Morningstar valuation it says it's 15% discount at the moment. And they expect the price to be $430 per share. And currently we are at 347. So it's got about 15% upside, which is quite nice. And then you've got 200, tip rank says 336% upside and $490. And they are saying it's a strong buy. Now, this company, Simply Wall Street, decided to be stupid. I don't know what on earth is going on here. Okay, they're saying the company is overvalued about 700%. The price should be apparently $45 per share. They must be mistaken. There must be a mistake somewhere. Can't be. Or they had a fight with this company. I don't know what it is. So I just left that one out because it makes no sense. Okay, but I just wanted to show you just to be transparent. Okay, so that's what they say in the price is right now, which is where it is around now. And that's what they expect, which is very strange. Okay, so the next company you already know is Moody's. Exactly, that's more or less the same thing. They have financial services, investor services, or MIS software that allows them to rate these companies, look at the financial institutions, public financial ratings, all of that stuff. And they look at the other companies in terms of research and development, in terms of risks, in terms of debt, in terms of all of that, looking at quantitative credit scores, economic research, business intelligence, all of those things that they do. And again, I don't think they have a lot of overheads. A lot of that is you just need a software, you need a couple of analysts to look at that, analyze that data, collect it first to put it into the system. So when I say basic overheads, I'm talking about they don't have to they're not like creating machinery or anything like that. They're not spending a lot of money buying these products. Okay, they might get updates from the companies that create their software, like probably Accenture and so on, but that's about it really. So currently trading $303 per share. EPS again really good, about almost $11 per share. Market cap of 57, so it's slightly it's a lot smaller than SPGI or S&P and Global. They're similar when it comes to this. Slightly more volatile the SPGI. PE 28, more or less the same. Price to free cash flow again very similar, but enterprise value to EBITDA is quite low on this one. Again, we're looking for anything between 20 for these two, anything below 10 for the enterprise value to EBITDA. Dividend almost the same again. 5-year growth rate is 11%. Dividend growth streak of 21 years in a row. Payout ratio 22. This tells me they have plenty of cash, obviously, and plenty of room to actually grow this dividend. Okay, so it would be nice to basically get maybe another 5 or whatever percent. I'll check, in fact, how much they grew this dividend last year. Dividend safety 83%, so that's definitely safe. Profit margin 35.6, very similar to SPGI. Operating margins 46, and return on equity 95%. Total returns over the last 10 years. Look at that. This includes dividend and price appreciation, and this comes from Morningstar. So 22.96. Right. Let's have a look at the other one. Look at the difference. Okay. 22.91 to 96. So they are very, very similar, and that's in percentage as well. Okay. Current ratio. That is wrong. So that shouldn't be there. So current ratio, let me just double check that. One of the ways I find it is normally I go to Yahoo Finance, go all the way down, so statistics there, and then go all the way down. That's where it is, just over 1%, which is basically what we normally over 1, so what we normally need anyway. Okay, so 1.61. Now, in terms of growth for the next 5 years, okay, again similar, 14.8. This one was 14.2, so very, very similar in terms of the what is going on there. According to Simply Wall Street, this is undervalued about 13%. It's nice to have actually nice range and not $45 per share. Fair valued at the moment $346 per share. Morningstar 16% discounted, 10% discounted for this company. So they are more or less saying the same thing really. They are around the same. So 346, 350, 343, and according to TipRank, is actually moderate buy. Now that's in a nutshell the two companies that I want to share with you today. I don't want to make this video any longer, but I want to just say one more thing, right? I absolutely love the two companies. They've been on my shortlist for a very long time. In fact, I used to own them before, and I'm sure you've seen it in my portfolio, but I actually never had a whole shares, or I always had like a fractional shares. And at one point they became too expensive and I sold them. I think at the time it was just beginning around here. I think when they were like 400 or something like that. And look at that. If I had bought there right now, I'll be down about 26-27%. So right now it seems actually a fair valued, okay, especially SPGI. This is the one that I would be adding to my portfolio. Okay, I might not add it right now. I might just wait for a little bit margin of safety or whatever it is, because right now it is, let me see again, 347. And according to Morningstar, 430. Okay, that's not bad. So I don't know, I might add it this week, next week, but I will definitely be adding SPGI very soon. It's a quality company. This is the type of company I absolutely love, and the reason I love it is because they have a predictable business, but they have a wide economic mode. Okay, the capital allocation is absolutely brilliant. The financials looks great. They do pay dividend. Okay, they have been paying dividend for a very long time and increasing that dividend. They have enough cash in the bank. The profitability side of things is absolutely brilliant, and there's a bit of a growth in there. And right now it seems fairly valued. So why not? This is the type of business you should own, not the companies that have not making any money, they don't have economic mode, they don't have anything going for them. And again, these companies they have some sort of a stickability, if you like, or the economic mode. What I mean by that is, once you start working, so if investment banks works with this company, to switch from this company to another company, it will take them a long time. Okay, so because of that, the majority of the companies stay with them. Even if they increase the price, they still stay with them. And that's the kind of company I want to own, especially right now when we are in a situation where there's so much uncertainty in the stock market. This is the type of big company that you want to own. But again, it's not a financial advice, okay? So please be careful. Do your research. Again, I will be going into the company website, learn more about the business itself and how they work, do a little bit of digging, okay? One of the things I will definitely be doing is go to the financials, go to the income statement, look at the last 5 to 6 years, so 44.4 billion, 48, 53, 6. So that is the kind of thing I want to see. Look at the cost here, cost of revenue, very, very small, from 1.2 to again 1.6 in about 5 years. It hasn't grown a lot, but guess what? They've taken a lot of the money. So they basically made 4.4 billion and took 3 billion out. So this is why I mean they don't have a lot of overheads. Okay, look at their net income. A company that just made about 6 billion has basically taken a net income of $2.2 billion. Okay, then you look at the balance sheet, then look at all of these things, okay, before you start investing. That's all I want to say. I hope you're having a great day. Assalamu Alaikum, and see you next time.